big story forward this Friday morning, which is that amendments in the new finance bill, which means the huge indexation benefit which mutual fund investors, especially debt mutual fund investors, were enjoying, that is going to change. What are the implications of that? Is this something which is going to be changing the way how HNI investors, forget HNI investors, every investor is looking at debt schemes now? Feroze Azeez joins us, Deputy CEO with Anand Rathi Private Wealth. Feroze, good morning. Thank you for joining us. Feroze, I just realized a few days ago we actually live in the same building.
Yes, we could. Good morning, sir.
I don't get to see you in the building, but it's good to see you at least on air.
Yeah, it's a privilege to be your neighbor.
Pleasure's mine. Okay, what does the new amendment in the finance bill mean for mutual fund investors?
Yes, Nikunj Sahab, it definitely means a lot. This amendment actually eliminates several categories outside the gamut of the long-term capital gain and the indexation, brings in the umbrella of Section 50AA on several classes. Apart from liquid fund, I think liquid fund most people don't buy from a 3-year perspective. The rest of it all gets impacted. This is the first time I've seen prospective application of a certain section like 50AA is going to be prospective 1st April onwards. I've never seen one scheme of a few fund having 2 different units being taxed differently. So it has a large impact. Today we have just about 60 lakh unique debt fund investors. That was supposed to be expanded to a larger universe, given the affinity towards debt for an Indian investor. But I think that's going to be definitely dented going forward.
For a debt investor, one huge draw was benefit of indexation, but it is also about asset class planning. So while indexation benefits are gone, but I'm sure debt schemes and debt investors would be cognizant that when you're investing in debt market, you're also taking a bet on an instrument. So that basic matrix does not change.
Yes, Nikunj, it doesn't change at all, because taxation is the last criteria on the basis of which an asset or a vehicle should be chosen, point 1. Point 2, I personally think always taxation is never at an instrument level, it's at a file level. Let's assume in my house there are 3 files, right? My wife, myself, and my child. There are 3 different files. Instruments by standalone can't actually tell you what tax you will end up paying. Because even if you have short-term capital gain, it's not interest income. So Section 73, which allows you to set off several things for 8 years, can be used. Second is, in the new tax regime, for example, if I'm investing, I will invest my debt investments from my child's portfolio because he does not have an income. So up to 15 lakhs, the taxation is as little as 10% in the new tax regime. So I'm not too concerned for a retail investor. I work backwards for about a 10 crore portfolio as well. This will not materially change the merit of having that instrument in one's portfolio.
Subramaniam also joins us now. Sunil, good morning. Thank you for joining us. Sunil, we are debating with Feroze that the amendment to the new finance bill and what impact that will have on the debt schemes and on the total assets under management for AMCs. Sunil.
So, first of all, I don't think, since we are providing a grandfathering, I just went through the proposed amendment, we're providing grandfathering. So, I actually expect that up to 31st March, you'll see a lot of money come into debt schemes, because once you put in before 31st March, you can hold it forever and claim indexation as long as you want. So, I see a big shift happening in the last week of March from other asset classes into debt mutual funds. That's number one. Second is, post April 1, obviously debt mutual fund investors, because HNIs were using this as a very tax-efficient instrument compared to, say, bank deposits or other NCD investments. So now I see that definitely fresh inflows from HNIs into debt who do it on a taxation basis within the debt category, I think we'll see. Obviously, it's going to be hugely positive for bank deposits. The third aspect to this I see is that it's also going to retard the development of the debt capital markets for India. So as we are now going to a new capex cycle and corporates need more money, using debt capital markets, now if mutual funds are not going to get money from investors in debt category, how are they going to finance the capex cycle? So I think now they'll be more and more dependent on banks and term loans for financing their capex. So I think that this is a backward step from the overall capital market development, the debt capital market development in India, and compared to the advanced countries, we'll be way, way behind. The fourth thing is that I don't expect a switch from debt to equity in this. And I agree with Feroze that asset allocation, is not based on taxation. It's based on goals, the risk appetite, financial planning and all that. So, but there's a small category within the equity mutual funds which could benefit, which is called the equity savings funds. What equity savings funds do is they keep their debt only to 35%. The balance is put in arbitrage and in equities. Now, what it is, it gives debt-like return, but with equity taxation. So, at the margin, I would see some amount of flows from 1st April onwards increase in this specific hybrid category, where the risk is minimized, but at the same time, you're getting a tax benefit. Then, finally, I would say that this is not just about debt mutual funds. It's a whammy for international investing funds as well as gold.
Just to understand it a little bit better as well, Sunil, wanted to get in your take as to whether or not this is going to be advantages or a benefit now for FDs and pure equity schemes in your take?
Definitely a benefit for FDs. And within equity schemes, I just mentioned equity savings schemes are the ones which would stand to benefit because they keep their debt allocation to 35 and they keep their equity as a mix of arbitrage and pure equity. So that's one category benefit. Otherwise, overall, I don't think that it's more beneficial for bank deposits and other instruments rather than for equities, I would say. That's not really something that I expect.
One final word from Feroze. Feroze,
Yes.
let's understand if you have to weigh in, let's say, the advantage FD versus advantage fixed income. While we are discussing and debating that this entire new resolution, this amendment is going to be beneficial for fixed deposits, do you think totality, it may not actually happen that way?
Because I subscribe to what you just said. It will not change materially the love for FD or debt funds. I was reading one of the reports, it says that 1 crore 70 lakh crores is there in FDs. It is but apparent that in spite of having interest income, if FDs have had such a pull, that automatically implies that quite a few people are not worried about interest income because they don't fall in the income tax slabs of the highest rates. Will it impact the love for FDs of an HNI? I think they will be more keen for an FD, but I think most of India is not earning more than 15 lakhs, and especially a family of 4 is not. So I don't think a large flight of capital from debt funds to FDs is going to happen. FDs had the larger portion. It had almost 10 times the portion ex-liquid than debt funds, in spite of having a tax disadvantage of interest income, which does not get Section 73, you can't gift it to a major child. FDs are non-transferable. MF units are transferable. So you can, as a family, always manage the tax, and your CAs can very easily help you. Even if you have a 10 crore portfolio, I think the tax will not even change by 2-3 lakhs a year. Even if you are a 50-50 investor between equity and debt, I think people will try and combine these. Most people have 1/3 in equity anyway. So industry is going to create different funds, which is going to combine these two. Most investors have at least 35% in equity anyway. So the industry has to calibrate their product offering to make sure that this tax disadvantage doesn't remain. And arbitrage, I'm sure, will now form a part of most debt funds.
All right. Gentlemen, really appreciate your time. Thank you for joining us. So